Stocks versus real estate. It's a long-standing question and one that isn't easily answered. This is Deidre Woolard, editor at Million Acres, the real estate investing website from the Motley Fool. And today we are asking the question, should you invest in real estate or stocks? We all know that putting some of our assets in real estate is good for diversification, but what about returns? Which asset class has produced better returns over long periods of time, real estate or stocks? This is a tough question to answer, partly because there's no reliable way to gauge individual investment property returns on a wide scale. Every property investment in each market is different, and so there's no real way to make a comparison on a one-to-one basis. Having said that, though, there is some broad stroke data that can help us compare how the two asset classes stack up as long-term investments. First, it's important to note that stocks tend to increase in value quicker than real estate. Over long periods of time, an S&P 500 index fund has historically produced total returns in the 9 to 10% range. Meanwhile, real estate prices tend to outpace inflation, but not by much. Since 1940, the median home price value in the United States has increased at an annualized rate of 5.5%. However, this is misleading for several reasons. Consider this. Homes are significantly larger today, on average, than they were back then. The average home in 1940 was 1,246 square feet, roughly half of the 2,430 average of 2010. So if you adjust for home size, the annualized increase on a per square foot basis drops to 4.6%, and after accounting for inflation, the average home value has risen by just 1.5% per year. Now let's compare this to stock returns. Stocks have generated roughly 7% per year over the long run after accounting for inflation. In other words, the stock market has generated returns at more than 4 times the rate of real estate appreciation. If you've ever heard someone tell you that your home isn't an investment, this is probably why. But wait, there's more to consider in this question, and this is important. Real estate, as an investment, has much stronger return potential. Real estate values tend to barely outpace inflation. However, there are a few reasons why real estate investments tend to do better. The first is leverage, also known as investing with someone else's money. Unlike stocks, where it's irresponsible to invest with borrowed money, you can use significant amounts of financing for real estate investments without adding a ton of risk. When you buy stocks or mutual funds, most people buy with the cash they already have. In real estate, you are generally only putting down a down payment and financing the rest. This means that you are making your investment using your money as well as the bank's money. Although real estate does experience price swings over time, they tend to be far less dramatic than stock market swings. So if you look at the most dire periods of the real estate market, aka the Great Recession, the simple truth is that investors got into trouble with debt during the financial crisis for 2 reasons. 1, they stopped caring about their property's cash flow and focused on price appreciation. People were essentially betting that home prices would go up because they go up, without focusing on fundamentals. 2, there are tons of creative mortgage products given to borrowers who are clearly not creditworthy. It's unfortunate that those people got roped into complicated products, but fortunately many of them aren't available anymore. If you use debt responsibly, it's a healthy part of a real estate investing strategy. Just don't forget about the core metric of any property, its ability to generate cash flow, when you're thinking about real estate investments. Lenders typically finance investment properties with down payments of just 20 to 25% of the sales price. When buying a primary home, the down payment requirements can be significantly lower. You may have to pay mortgage insurance with less than 20% down, but you may be able to put down as little as 3 to 5%, or in some cases, such as VA loans, no down payment at all. The effect of this leverage is that small returns can be greatly amplified. Here's an example. Let's say that you buy an asset for $100,000 in cash and its value increases by 3%. You earned a $3,000, 3% return on your investment. On the other hand, let's say that you buy a $500,000 asset by investing $100,000 of your own money and borrowing the other $400,000. If the value of this asset increases by 3%, you'll have a return of $15,000 or 15% of your initial $100,000 investment. This isn't a perfect example. When it comes to real estate, you'll typically have to pay an origination fee to a lender as well as various closing costs when you buy a property. These costs eat into your return. Plus, if you borrow money to buy a property, you'll need to make mortgage payments each month while you own it. That said, leverage can still dramatically amplify your return on investment, which is why most investors choose to use it rather than paying cash for properties. The second reason why investment real estate can produce strong returns is that investment properties can be rented out to generate income. You can also rent out part of a house and live in the rest, a move called house hacking. Real estate investors enjoy tax advantages that stock investors don't. For example, when you buy an investment property, you get to write off the purchase price over a certain number of years, a tax deduction known as depreciation. Now, it would be awesome if you could write off your stock investments in a similar manner, but that isn't the case. Even if you don't own a property, real estate can offer tax advantages that the average equity investment can't. Real estate investment trusts, or REITs, get an extra tax benefit in that they avoid corporate taxes by paying out most of their income as dividends. REITs are easy for investors to buy in an IRA or other tax-advantaged retirement account, meaning they can avoid dividend and capital gains taxes altogether in the short term. Together, the combination of rental income, leverage, and tax benefits can combine to produce attractive long-term gains. So how has investment real estate compared with stocks over time? It's difficult to find reliable historical data on total returns from individual investment properties. There are too many variables and there's no reliable way to track total returns achieved by individual investors. However, one good way to visualize the power of real estate investments is to examine how real estate investment trusts have performed over time. Let's compare the total returns of the S&P 500 stock index and the Vanguard Real Estate Mutual Fund, a good benchmark index of equity REITs. The difference isn't too significant over the first few years, but by 20 years out, the Vanguard ETF crushed the S&P 500. Real estate stocks tend to be correlated with interest rate fluctuations over short periods of time, which is the main reason for the big underperformance over the 3-year period. Rising interest rates are bad for REITs, and the Federal Reserve raised interest rates 8 times over the past 3 years. However, over longer periods of time, the effect of interest rate fluctuations tend to balance out, and we can get a better look at how the performance of these two asset classes stack up side by side. If you look at the longest time period, you'll notice that the performance is comparable, but with a significant edge to real estate. This is an imperfect conclusion, as that there are other ways to invest in real estate besides REITs, and they have different investment dynamics. But it does illustrate the long-term return potential of real estate investments. Now, there are some downsides to real estate investing. Actually, buying real estate is a time-consuming investment. Hiring a property manager helps, but searching for, evaluating, and buying properties consumes far more time than simply buying stock. Also, real estate is an illiquid investment. You can sell stocks with a couple clicks in no time at all. Conversely, it can take months to sell an investment property unless you want to accept a highly discounted price. Of course, if you invest in real estate investment trusts, you have the same flexibility that you would with stocks. However, to really see the benefits of REIT investing, it generally makes sense to hold these investments for the long term. It's tough to make an apples-to-apples comparison of the two, but it's fair to say that real estate investments have just as much, if not more, return potential as stock investments. When you combine the safe use of leverage, price appreciation, income potential, and the inherent tax benefits of real estate investing, there's potential for impressive long-term returns. In the end, you don't really have to choose. Since stocks and real estate investments are vastly different and each offers their own advantages, why choose? A diversified portfolio with stocks, bonds, and real estate will put you in a position to better weather market hiccups while also seizing the relative advantages each asset has to offer. If you like this video, please let us know by giving us a thumbs up and subscribing. And if you have a question we didn't answer, drop it in the comments section below. And if you want more information on investing in real estate, we have a free 40-page guide. Just head over to real.fool.com to download your copy. And remember, we publish new content on real estate investing daily on millionacres.com. Thank you for watching.